Assalamualaikum. We are from Group 10. So we will present about the economic exposure, which include how to measure economic exposure, the illustration of operating exposure, the determinants of operating exposure, and how to manage operating exposure. As an introduction, economic exposure can be referred as the extent to which future cash flows are affected by the unexpected changes in exchange rate, and it is also known as operating exposure. So, when the foreign exchange volatility is increased, the exposure will be increased too, and vice versa.
Hello, my name is Dayang Kukuratul Anshafika binti Awaku Junaidi, matrix number BB1911084. So I will present about how to measure economic exposure. Economic exposure is the sensitivity of the future home currency value of the firm's assets and liabilities and the firm's operating cash flow to random changes in exchange rates. There are two existing statistical measurements of sensitivity. One, sensitivity of the future home currency values of the firm's assets and liabilities to random changes in exchange rate, and second, sensitivity of the firm's operating cash flows to random changes in exchange rate. As can be seen on the slide, there are two examples of regressions. One is assets exposure. The regression can be seen on the slide, where the P is dollar value, A is regression constant, B is coefficients, S is asset on the dollar or pound exchange rate, and E is random error term with mean 0. Second is regression coefficients. The regression can be seen on the slide, where the B is coefficients, COV PS is the covariance between the dollar value of the assets and the exchange rate. VARS is the variance of the exchange rate. P is assets dollar value and S is exchange rate. Using a numerical example, we demonstrate how to use the exposure measurement approach. Suppose that the US has an asset in United Kingdom, UK, whose local currency price is random. For simplicity, assume that there are 3 possible states of the world, with each state equally likely occur. The future local currency prices of this UK asset as well as the future exchange rate will be determined depending on the realized state of the world. Case 1 shows that the asset's local currency price and the pound's dollar price are positively connected, implying that the pound's depreciation or appreciation versus the dollar is linked to the asset's local currency price falling or increasing. This can conclude that the US company is exposed to significant currency risk. In case 2 shows that the asset's local currency value is obviously inversely tied to the UK pound's dollar price. The impact of exchange rate changes is precisely offset by variation in the asset's local currency price, making the asset's dollar price completely immune to exchange rate fluctuations. The asset's future dollar price will be uniformly $1,400 in all 3 states of the world. And the last one is case 3, where the local currency price of the assets is fixed at £1,200. In this situation, the US company is dealing with a contractual cash flow in pounds. This scenario illustrates a unique kind of economic vulnerability known as a transaction exposure. That's all from me. Thank you.
For illustration of operating exposure, suppose that a United States camera company has a Malaysia subsidiary, Nikon Corp, that is manufactured and sold Nikon camera in Malaysia. Nikon Corp imports some parts of the camera from the US company with a total of $876, which costs RM3,809 ringgit. It is expected for the company to sell 9,000 units of the camera per year with the selling price of RM10,000. The variable cost for each unit is RM7321. The operating cash flow is RM21 million. Assume the ringgit Malaysia depreciate from 0.23 to 0.13 per ringgit Malaysia. There will be 3 scenarios. For case 1, the cost of the imported supply is the only variable that change. Case 2, there are no further changes to the selling price or the cost of the imported input. Case 3, every variable is changed. To conclude, the change in exchange rate can affect the company's operating cash flow. The company might either gain an increase in their operating cash flow or a decline in the operating cash flow as illustrated in case 3.
Basically, operating exposure cannot be identified in the same way as contractual, which is transactional exposure. It is more likely easily determined from the firm's accounting statement. A firm's operating exposure is primarily determined by the structure of the market in which the firm sources its inputs such as labor and materials and then sells its product. It also can be determined by looking into the firm's ability to mitigate the effect of exchange rate changes by adjusting its markets, product mix, and sourcing.
Greetings to everyone. My name is Muhammad Ali Faikal bin Udin. My metric number BB1911053. Today I will present about managing operating exposure. The firm can use these strategies to manage the operating exposure. First is selecting low-cost production sites. Second, flexible sourcing policy. Third, diversification of the market. fourth, product differentiation and R&D efforts. And last but not least is financial hedging. That's all. Thank you.
As the conclusion of our topic, economic exposure is something that cannot be reduced easily, as the volatility of exchange rate is unpredictable. So, as mentioned before, there are several ways that can be used to ensure a stable cash flow due to the changes, as it is not only affect the cash flow, but also the competitiveness of a company due to the price of goods produced. That's all from us. Thank you.